Are you ready to make more profit with your current trading strategy? Then listen up, because today we are going to talk about mastering position size and risk reward ratio. So let's get right into it. Position size is a crucial factor in managing risk and maximizing profits. Position size refers to the amount of shares or contracts you trade in each position. But how do you determine the right position size? It all comes down to assessing your risk tolerance, account size, and market circumstances. But first, let's talk about risk to reward. The risk reward ratio, for short RR, is a measure that compares the potential profit for a trade to its potential loss. A good risk reward ratio ensures that your profits are greater than your potential loss. For example, a trade with a risk reward ratio of 1 to 7 suggests that a trader is willing to risk $1 for the possibility of earning $7. I can hear you guys thinking, why is this important? If you are a trader and you use a 1 to 2 risk reward ratio and you have a win rate below 50%, you will lose money. But if you have a 1 to 4 risk reward ratio and you have a win rate of just below 50, you will make profit. With a 1 to 4 risk reward ratio, you will even make profit when you have a win rate of 25%. That means you will make profit even if you only win 1 out of 4 trades. I'll show you guys the math. So you have a 1 to 4 risk reward ratio, you risk 1, you make 4, you have 1 winning trade, so you have $4 profit now, and then you lose 3 trades where you lose $1 each. So 4 minus 3 is 1, so you still have your $1 profit when you only won 1 out of 4 trades. Are you guys starting to understand it? A 1 to 3 risk reward ratio is the minimum you should aim for before entering a trade. With this RR, you only have to be right 1 out of 3 times, or 33.3%, and you will still make money. And if you are able to develop your strategy more and more to get your win rate up to around 50%, which is a really good win rate, you will start to make loads of money with a 1 to 3 risk reward. But of course you won't get there by just looking at the chart. So how do you calculate your risk to reward ratio? You really don't have to, because TradingView will do that for you if you use the long or short position tool. But if you want to calculate it, you can simply divide your target profit by your stop loss. Now let's dive into position size. There are various methods you can use to calculate position size, but the most popular approach is the percentage risk model. We use this method, and almost every other good trader out there uses this method too. This model allows you to adjust your position size according to the risk you want to take on. I recommend to risk no more than 1 to 2% of your trading capital on every single trade. I usually use 1% risk, but depending on the situation, I use less or more. You can easily search for a position size calculator on the internet, but I'm going to show you how to calculate it yourself, which is a little bit harder than just filling in a form on the internet on a website. With some simple math, we can easily calculate our position size before we enter a trade. Our stop loss will be the most important factor to calculate this. Let's say we have a $1,000 trading capital and we only want to risk 1% every trade. Let's say we found a setup and we found a suitable stop loss at 0.5% away from our entry. If we enter this trade with $1,000, we are only risking 0.5%, and that's half of the 1% we wanted to risk. We can fix this by simply doubling our position size using leverage. So we will go into the trade with $2,000 instead of $1,000. Let me show you the math. 1% of $1,000 is $10 and 0.5% of $2,000 is also $10. So you risk the same amount while you are using more money. This is because of the percentage your stop loss is away from your entry. In the last example, our stop loss was closer to our entry, but I'll give you another example where our stop loss is further away from our entry. So again, we have $1,000 trading capital. We want to risk 1% on one single trade. We found a setup and a suitable stop loss at 2% away from our entry. If we enter this trade with $1,000 trading capital, we are risking 2% of our trading capital, and that's double of what we wanted to risk on this trade. We can simply fix this by dividing our position size. So we will go into the trade with only $500 instead of $1,000. I'll show you the math again. 1% of $1,000 is $10 and 2% of $500 is also $10. So again, you risk the same amount of money, but this time around we are using less money. So basically you calculate how much more away or closer your stop loss is from your usual risk, and then you multiply or divide accordingly. I hope you guys understand the math I just told you guys, but if you have more questions about this, don't hesitate to ask them in our Discord server. Remember, trading is all about managing risk and preserving your capital. By mastering position size and risk reward ratio, you can potentially increase your profitability and reduce the likelihood of a major loss. So next time you are planning a trade, take a step back and consider your position size and your risk reward ratio. It could be the difference between success and failure in the trading world. Thank you guys for watching, and if you found this video helpful, please subscribe to stay up to date for more trading tips, education and strategies. Enjoy your trading journey, guys.